let's talk about something that probably not a lot of people know about today is DSCR loans in the mortgage world. It stands for debt servicing. It's for investors. Jared, you deal a lot with this. What's your initial take with DSCR loans and investors?
Well, we're glad you asked, Will.
So glad you asked.
Yeah. No, the DSCR, the debt service coverage ratio, so ICF they call it now, which is investor cash flow, which is just a prettier way of saying it. But these are great loans. These are loans that were always designed for investors because most most real estate investors, I should say, usually don't have the best credit. They don't have the right income that's reported, and they don't qualify for traditional loans. So where most loans in residential lending are based off the person has to qualify for the house, right? Their income and their credit, their equity and all that stuff. This is more on the investment itself. The property is qualifying for itself. So debt service coverage ratio. Does my mortgage, my principal, interest, tax, and insurance, does it cover the income on that property, right? Like if it's going to rent for $3,000 and my principal, interest, tax, and insurance is $2,900, that rent covers the debt. And that's pretty much all it is. They still have loan to value. They're not going to give you a bunch of money. This is for investors, right? We're seeing some of this pricing for these rates, not much different. They're different than regular residential loans, right? Regular Fannie, Freddie, conforming type of loans, which is great. There used to be a big spread. Now there's a lesser spread, right? So I would say I've seen them down in the mid 6s for a really good person, and I've seen them up to the 9s and 10%, but they're investor type of loans. So again, you might be self-employed and don't show all the income on your taxes, or you might get income from other sources that you don't report, or whatever the case is. You don't need to worry about any of your income, no taxes, no pay stubs, no W-2s, nothing like that, no bank statements if you're trying to do a DSCR loan or ICF loan. So that's kind of what it is. And you could still get them even up to 85% of the value, which I believe is the same that Fannie and Freddie will do on the max for an investment property. The good thing with this on that part, like 85% is the max, which with a Fannie and Freddie, sometimes because it has so much layers of risk with them, that it will actually not be compliant. So even at 85%, even if you had all your income was reported correctly, a lot of times you still won't qualify for 80 or 85% because Fannie has different loan level price adjustments, layers of risk that prevent it from being in compliance, where the DSCR is typically doesn't follow the same compliance guidelines. And if you have to charge more or pay more rather to get it, you're allowed to. So that's kind of what it is in a nutshell.
Let me ask you this. What if my mortgage is higher than my rent? Can you do a loan with that?
Well, that's the thing. They're really popular. So think of it like right now, 20% of the buyers out there or more. I mean, it's probably maybe in the 30, 35. We're looking at about 40% roughly of buyers are investors, right? But it's hard to say how many actually getting financing because a lot of them are cash buyers or just regular investors. Could be, mom and pop buying an investment. It could be, I'm itchy, man. Sorry, this poison ivy's all over. Gosh, I can't stop. So yeah, you're getting, you call it 20%, go with the lower. 1 out of 5 people buying a house right now are an investor buying the house or for buying it for an investment. So can you do it if your rent is less than the mortgage? Absolutely. There are investors that go with a negative ratio.
Rates a little higher because it's a little riskier.
So, your rent could be $2,500 and your PITI is $2,700. They will still do it. Now you will have adjustments on the rate because it's a different level of risk, right? Any loan out there has different levels of risk. That's why there's different pricing adjustments. It's not like it's not Oprah. Not everybody gets the same thing out there, right? Like, oh, my 580 borrower at 100% gets the same as my 800 credit score at 20% loan to value. It's not like that. There's layers of risk on it because people are lending you money to buy something based off either the property or yourself.
Right,
but yeah, they can be done. I've seen, so if we're looking at a 1-to-1 ratio, my rent would be, $3,000, my PITI is $3,000, right? If my rent's $3,200 and my PITI is $3,000, then I'm higher. I might be at like a 1.1 or something around that. If I'm 2,800 and it's 3,000, I might be like a 0.9 or a 0.85, right? Because it's not covering that ratio there fully. Right. That is still doable, though. I still see it, just different layers of risk.
Yeah, I didn't know about
because
these loans for a while.
We know rents are going to go up, right? Rents consistently go up. So it might not debt service now, which means you still got people doing it, but it might debt service in 2-3 years or whatever the case is. Right.
Yeah, I didn't know about this loan, and obviously it's for those people that don't qualify on paper with their self-employment or rent, the investors that, write off everything and they don't, calculate income on taxes. Great. So a great loan for those investors to get money out to buy. So yeah, I love that loan. It's a great point that you make, that maybe you're not going to debt service in the first 2 years, but maybe once those rents go up in 2 years, those at 5% each year, and then the rates get lower in a year or two, you might, debt service above 1 at that point. So, yeah, think have a little foresight for long term too. But great loan. I love those because I love that they're available to do. So
they are available, and like I said, the numbers are high when it's one or 2 out of 5 people are getting these types of loans or are buying under this circumstance of needing this type of loan. So we do them all the time, right? And they're all over the place. I mean, they're not for people. Well, I take that back. They might be for people even if you have income qualifying, right? If you're buying this is not a first-time home buyer situation typically. This is an investor. So I'm buying my next home or investment home where I have experience buying property, right?
Right.
You're not going to do, 3%, 5% down, first-time home buyer, no experience, and get one of these loans probably. So yeah, but I was saying you might, even if you were experienced and you had income and everything, I would still look at this option. I would still compare it. Just like I said, if the scenario is good and the risk assessment is low enough, you might even see it better than an investment home backed by Fannie or Freddie, than a regular conforming investment purchase loan. So don't forget about these. Talk to your lender if you are buying an investment. Make sure they understand it too, because honestly, dude, there's a lot of loan officers who don't know what these loans are, or they're just learning it because they're just now hearing about them. But hey, guys, these have been around forever. So just like most loan programs have been around forever. So I think it's important to make sure, if you are buying something, make an equal comparison, find out what's best for you, and make sure you're talking to somebody who's knowledgeable about it, hopefully more knowledgeable than you can be about it by looking on the internet.
Right. Well, good to know. Good to know that those loans are out there. Investors, if you want to become an investor, I would look into this. Maybe plan something out for the future. But great loan. Anything else you want to add about ICF and DSCR type loans?
No, man, they're great loans. Like I said, reach out to us if you don't have anybody. If you do work with a lender and you're trying to buy investment properties, ask them. You're not going to learn anything unless you ask questions. Talk to people. But yeah, no, it's a great loan. It's an easy loan. Like I said, no income docs, no validating tax returns, verifications of employment, or anything like that you have to worry about. There's no income. It's based off the property. It's based off getting what the rent schedule is or the rents in the area are, and does it debt service. If that's something that you're looking in, or you think you might need or might benefit you, definitely do some more digging and ask questions about it.
All right, let's wrap it up. That's DSCR loans, everyone.
Awesome. Love talking about these. If you want more questions or have products that you want us to talk about, let us know. Hit us up, and we'll be sure to add it on our next videos.